We can start.
Okay. Good morning, everyone. Welcome to the Real Assets Committee meeting of September 8th. Can we go ahead and take the roll?
Carol.
It's Caroline.
She should be on. If not, I can just jump in.
Okay.
Okay, so sorry, I'll just do it 1 second. Thank you, Chair Jones. I will start off by doing the attendance. Mr. Jones?
Here.
Okay. Mr. Bernstein?
Here.
Mr. Knox?
Morning, I'm here.
Ms. Sanchez?
Here.
Mr. Green? I'll be joining in a couple of minutes. Staff participating includes CIO John Grable. I have PIO Jim Rice and our consultants from Alborn team, Makita team, and the Stepstone team will be participating. Trustees, please use the Zoom chat option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak. And now we may proceed with the agenda.
I'm present.
Oh, I'm sorry, I didn't call on the remaining trustees. So sorry, let me go back. Mr. Santos? Mr. Santos?
Herman.
Here.
Thank you. Mr. Kehoe?
Present.
Thank you. Ms. Greenwood? Mr. Kelly?
Present.
Okay, and we're done with the attendance.
Okay, great. Upon review of the minutes, are there any comments or anything before we make a motion to approve them? Any amendments to anything from the meetings from minutes from August the 11th? If not, can I have a motion to approve them?
I'll move. I'll
Okay.
second to Ms. Sanchez then.
Okay, good. Sounds like he got the motion and Ms. Sanchez with the second.
Okay. I'll start with the roll call. Mr. Jones?
Here or present? Yes.
Present. Yes. Mr. Bernstein?
All the above.
Aye.
Okay. Mr. Knox?
Aye.
Thank you. And Ms. Sanchez?
Aye.
Thank you. The motion passes unanimously.
Yes.
All right, Linda, I didn't see anything ahead of time, but did we have any public comment or anything that came in related to the committee at all?
We do not have any public comment.
Okay, super. All right, so then directly on to the main entree, then from Stepstone. Jim, did you want to do the soft intro, and then we'll look forward to hearing from Margaret, Tom, and Anja.
So this item is an item that we added on to the agenda. Stepstone was recently brought on as our real estate consultant a few months back. They've conducted their initial assessment of our portfolio and have prepared some materials for the committee to review. So presenting from Stepstone today are Margaret McKnight, partner, Thomas Hester, managing director, and Anya Ritchie, a principal. And then one thing I would just want to point out is that this item is agendized as a report. We intend to come back to the committee and the board with recommendations at a future meeting. And we are intending to do that as part of the structure review scheduled for December. So with that, I would like to turn it over to the team from Stepstone.
I'm so sorry, Jim. Is Imran Zahid part of the Stepstone group?
I don't believe so.
No.
Okay.
No, but,
Thank you.
but we
part
are
of the Makita team.
Okay, good to know. I'll go ahead and let him in. Thank you.
Yeah, and we are joined by James Mena also. He's not speaking today, but he's part of the Stepstone team who's on the meeting.
Got it. Thank you.
Okay, well, Jim, thank you for that. And good morning, everyone. Tom Hester, Managing Director, Stepstone. As Jim mentioned, I'm joined by my colleagues today, Margaret McKnight, Anya Ritchie, and James Mena. And with that, I think we should get right into it. So let's flip to slide 5. Looks like we're already there. And by the way, I'm having technical issues, so I'm on my phone today. I won't be zooming in. So the executive summary, yeah, I mean, quite simply here, we think that, I mean, this is not news to anyone, on the meeting today that LACERA's real estate portfolio has consistently underperformed against a custom benchmark and its peer set. While that is the case, we believe that the drivers of that underperformance are investment selection and execution. So, for example, overall property type and geographic diversification against the NCREIF National Property Index are fine. And the leverage levels overall, while a bit higher in the core portfolio, is not the significant concern at this time. Also, we believe that the portfolio risk is very high due to high concentration and asset level issues. So, for example, the tracking error we estimate at over 4.4% is simply too high. The tracking error against the market is not acceptable. We believe that the core portfolio includes non-core risk, and Margaret McKnight later in this presentation will discuss that topic in detail. And then there is high operational risk. It's our conclusion that this is a problem as staff focus, in our view, an inordinate amount of time, not as investment officers, but on more administrative and bookkeeping tasks. Given the underperformance, we think that when you couple that with the risks identified and those that we're still evaluating now, it's a problem, and that both can be meaningfully reduced with some repositioning of the portfolio itself. On slide 6, the methodology, I won't spend a lot of time here. We're using performance data as of March 31st. Some of the exposure breakdowns that we'll discuss in the non-core section are as of June 30th. As many of you may know, that the record keeping and the transition of all of the data and the performance information, the historical performance from Townsend to Stepstone is in transition. We have not experienced any major items in that regard. We are up and reporting now and being fine-tuned, and we will spend a good amount of time with staff developing a reporting template that's bespoke and fills the association's needs. The portfolio organization is forward-looking. Value-added exposures are now included with opportunistic, which was formerly high return, to create a complete non-core bucket, which we think is a good move. Get the value add out of the separate it from the core, as has been previously carried. And the credit portfolio, of course, is not included in this review, other than maybe 1 or 2 sightings of it due to the fact that it has been transferred to the credit function asset category. Let's go to slide 8 now. Portfolio roles and objectives. It's helpful here to review the reason LACERA has the real estate asset class, and the goals and objectives are sound for each sub-asset category shown. For the most part, this presentation, a little later, will focus on the IMA core component of the real asset and inflation hedge holdings. I think that with regards to, if you look to the left there, that 85.4% current classification of the portfolio of core is going to be the main subject of our discussion a little bit later. On slide 9, this is not new. I think we all know that the portfolio on a time weighted return basis has lagged the benchmark in many vintages. Here we're just showing it over the 5 and 10 year. The 10 year, being off 150 basis points it has to be fixed. That it's unacceptable, and we think that we early in this assessment are creating the tools to help you do that. This is an interesting slide on slide 10. What we did was we compared the performance, LACERA's portfolio performance, to a set of 8 Stepstone public and defined benefit plan clients, which includes 7 public plans and 1 defined.
Could you please turn the page?
Oh, I'm sorry. Yes, 10, please. There you go. Thank you, Margaret. Let me go back. So this is a peer set comparison. And what we've done is we have the green bar represents LACERA and the gray bars represent the peer set. And you can see again underperformance against our peer set. Our peer set includes 8 public and defined benefit plan clients, which is 7 public plans and 1 large corporate plan with similar overall real estate investment program guidelines. And you can see in the next bullet that the portfolio construction is a bit different. This peer set is 51% core. But what I would say to you is this is significantly true core because these clients invest primarily through funds. And Odyssey core funds, while they may have a very, a component of build to core holdings, they tend to be almost exclusively focused on core. And that 51% core figure we see here is probably closer to what, based on our initial assessment, the LACERA portfolio is actually holding. As I mentioned, we're questioning the 85% core allocation as categorized now, and Margaret will talk about that in a moment. So with that, I will turn it over to my colleague Anya to go over the non-core portfolio starting on slide 12.
Thank you, Tom. Thanks everyone for your time today. So we'll be diving right into the non-core portfolio overview. As Tom has alluded to earlier, this time we are classifying here your non-core IMA holdings as well as the funds together into one bucket to really move closer to what the industry looks at, but also your new guidelines. The upper two charts are really showing something very similar that Thomas just presented for the overall portfolio, but here just looking at your non-core exposures, we're comparing your value add and opportunistic time-weighted returns against your constant benchmark. And what I think it becomes very clear when you look at the bar charts is the underperformance. So in the 5-year time horizon, underperformance is at around 120 basis points. And on a 10-year mark, it's around 360 basis points. The non-core portfolio overall is more than 2/3 of it are funds, commingled funds, and less than 1/3 is really sitting as NAV in the IMAs. And again, Margaret is going to spend much more time on the IMAs later on again. Again, also close to what Tom had said earlier, the underperformance here, if you look at this, is really coming from the non-core allocation. Non-core value add opportunistic funds, generally those are strategies that do have a lot higher risk in execution and leverage, for example. So underperformance here is always going to have a much bigger effect on the portfolio overall. Next slide, please. We've looked at a high-level exposures, which are generally very reasonable. If you look at it by geography, you have a bias towards North America, which is probably by design and totally what we see with a lot of other clients. By property type exposures, you are overweight to residential and probably also to retail at 19% here in the non-core bucket. This is coming out of the IMAs. So you have currently 7 IMAs, 4 of those are exposed to multifamily and 3 to retail. If you look at just the commingled fund portfolio and the allocations or exposures by property type, it's actually a very neutral portfolio overall. Vintage year exposures very much diversified across vintage years. This varies as funds really invest and then harvest, but overall, steady pacing has slowed a little bit, and you're slightly overweight 2016 and 18 vintages currently. If we're moving to the next slide, we will just, not spend a whole lot of time here to talk about the details, but we have really focused on looking at the active funds that are currently in the portfolio, not really all the historic investments that you've had. And we've been ranking those or assessing those really on 4 different verticals. And that's a process that we typically go through quarterly, where we look at the organization overall and the risks in the organizational setup, strategy, performance and structure. And again, all of those 4 verticals will have different, subsets that we assess. And overall here you see that, there's room for improvement. It's not bad really, but there's room for improvement. And SRE, we typically also quarterly rank our funds according to potential outperformers or top picks, meaning those are funds that we have high conviction in. And you can see here that from these funds that you currently have in the portfolio, we have ranked 5 of them, of those 17 as top picks or potential outperformers. So room for improvement, but again, just a high level overview of where we are today. Next slide. We've also looked at those funds, and don't be confused, this is one fund less than on the prior slide. That is because Kaplan 3 is so recent that performance is really not, you can't benchmark it yet. So you have 16 funds on here, and we've divided those according to their benchmark in first, second, third, and fourth quartile. And what you can see is that most funds, namely 9, are performing below the median, so in the third and fourth quartile, with 4 of them really in the bottom quartile, and 3 of those are performing the top quartile of their peer group, hence a good indicator for just how they're doing within their peer group, within their vintage year. Slide 16 shows probably what you're more used to seeing typically, which is LACERA's non-core benchmark, a core index plus a spread. We think that generally investors benefit from looking at both probably. So, what we're showing on this slide here neglects certain effects such as, performance through market cycles and the different life cycle of the fund. That is typically, early on drawing capital, there's a high J curve, you have fees, and then later on you create value or value appreciates, and then there's a harvesting period. So it's a different way of measuring performance really. And I think a portfolio overall, if you look at it, benefits from really looking at both benchmarking sets overall. And with that, I'm going to hand it over to Margaret. We can't hear you, Margaret.
Sorry about that. So the core portfolio has kept pace with the index over the last 5 years, but has lagged on a longer perspective. And we also think because there's additional risk in there that it maybe should have outperformed even in the last 5 years. The core portfolio is predominantly SMAs. It's 85% and only 15% funds. Next page, please. I'm going to talk briefly about the funds and then focus the presentation on the IMAs. You are invested in 4 core funds. 2 of them are industrial in the US and Europe, and those are both in the top pick or potential outperformer, according to Stepstone's evaluation. And a third one is IDR, which is an Odyssey index fund. So that's neutral. So generally speaking, your portfolio selection here is fine. These funds are not like the closed-ended non-core funds. These are open-ended funds that you can move in and out of on a quarterly basis. It can take a couple quarters to move in or out, but this is more liquid, and it's a place, the core and the core funds are a place where we can start to apply more of the skill set that we apply to liquid securities. And that's what we're going to do in a moment and talk about track and error. Next page, please. But first, when we peel the onion in real estate, we always start by looking at property type and geography because that has such a big impact on the outcomes. And your exposures from a top level are generally attractive. When you get down underneath, we're finding more things. But for example, your office, you're actually very far underweight office, which is a great thing. If you look at this, your exposures are the blue bars, your index, or sorry, the green bars, your index is the blue bars, and our recommendations are the light blue bars. So for office, we wouldn't recommend that you add office. That's more designed for people who most people have more. So that's a good thing, right? You have a lot of multifamily, that'll probably be index neutral over the future. Industrial is more poised to outperform. Less retail is better. The other, in your case, is student housing, and that's an interesting other. Senior housing is an interesting other. Data centers. There's a lot going on in terms of new property types that have a lot of promise right now, and we do recommend focusing on them. Outside the core portfolio, you just committed to Bain, which will have a big commitment to other through life sciences office focus. Your portfolio weightings by region are also attractive. You're heavily weighted to the South and West, which is predominantly where more of the economic growth is. We don't have generic regional guidelines because the devil's in the details here. if you look at the Eastern region, New York is kind of soft and Boston is very strong. And we prefer to focus on the more detailed exposures. That being said, your portfolio is a little more suburban Philadelphia than hotter Boston. And there's some other nuances, even on the property type side. Your industrial portfolio now is predominantly small bay, which is actually a niche category of industrial. Most industrial refers to very large warehouses, 150 million foot warehouses with longer term leases and credit tenants. Small bay industrial can be 5,000 or 10,000 feet, which means you have many tenants, which means it's really an operational business to keep the tenants, keep the space full, and such like. So it's an interesting segment, but it doesn't necessarily merit such a high allocation in an institutional portfolio. Next page, please.
Excuse me, Margaret. I just wanted to interject one point. There's some acronyms we're using in here. I just wanted to make sure we said what those were. We use the term IMA or SMA interchangeably. Those refer to individually managed accounts or separately managed accounts. Those are our wholly owned positions in our real estate portfolio that we own directly through other managers. So I just want to make sure that was that.
Can I ask a question, or should I wait until the end?
I'd love to have a dialogue if you have a question.
Okay, great.
Call.
Margaret, so I'm listening to what you're saying and looking at what, and I have this question actually of the others, but in core, I think this is more pertinent. Some of it seems like there are some, like you mentioned, nichier choices that were put within the core or within the mandates that we've given. Are the managers themselves, would you say that the managers themselves have other potential core products that we maybe could have been in or that are available to us if we like the manager but don't like the strategy that we've chosen to do?
Yes, so you own properties directly with managers, interfacing and actually doing the day-to-day management of the property, the asset management, etc. Most of these managers do have open-ended core funds, which I'm going to talk about in a bit, and closed-ended non-core funds. Most of your assets are with full service managers, so you could do any number of things with them. Yes. And I'm going to talk a little bit about that.
Hold on, Herman, real quick. Did you want to wait to the end of the presentation still, or did you at the pause? Did you have a question?
I can since we are here, might as well go ahead and ask the question. Thank you, Mr. Jones. Do you hear me? Everybody can hear me?
Yes.
Yeah.
Okay, good. Yeah, I wanted to, I was wondering if we can spend some time on the benchmark. I know at the beginning, your colleagues reported that it is your professional opinion that the benchmark is appropriate for a program here. And the reason I'm asking this is because for many years in the past, the previous consulting, every time I questioned why a portfolio was underperforming, she pretty much responded that the benchmark was just noise and pretty much advised that we should not pay attention to that, which is really counter to what I have learned over the years of the importance of the benchmark. So I was wondering if you can comment on that.
Well, the gold standard is what comes from the liquid markets, right? Which is a benchmark-oriented theory of investing. We can't perfectly do that in real estate, and there is noise, but we believe that the benchmarks are useful. Because there's noise, it can be helpful to look at multiple ones, which is why we suggested your focus is on the Odyssey benchmark. That is a core benchmark. And then when you move into the higher risk strategies of value added and opportunistic, you simply add 100 and 200 basis points. There is an index that is exclusively focused on non-core. It's not perfect, and it's less perfect actually than the core side, but it's a better representation of what actually happens in non-core because it's vintage year oriented and not time-weighted return, so that you can benchmark funds within their vintage year as we did and get some more detail about what's happening through the fund life, as Anya mentioned. Benchmarks are not the end all and the be all, but they are very useful tools. And what we're going to suggest, based on our analysis, that is more of a liquid markets analysis, is that a certain number of these open-ended funds collectively should deliver you outperformance versus the benchmark with substantially less risk than the present strategy.
Sorry, I was mute. I appreciate that. I think it's important because we need to, as a trustee, needs to be able to figure out how well the different portfolios are performing, and when a portfolio is underperforming, and the response is just don't pay attention to that, it's noise. And then I see other pension funds with similar real estate program outperforming their benchmark and doing better than we are. It was very concerning to me. So I welcome your comments. And that's the point I really tried to make. And thank you for Mr. Grable for coming in and seeing that we needed in the real estate portfolio. Thank you.
Thank you, Trustee Santos. Go ahead, Ms. McKnight.
Okay. So again, applying the tools of the liquid markets, we ran your core portfolio through our analysis and calculated that it has tracking error of 4.4%, which is high in context to the benchmark Odyssey portfolio over the long term of 6.7%. Approximately 80% of this is due to your high portfolio concentration in a very few assets, which is a result of the strategy of owning assets entirely and outright. And the market has moved away from that because of these open-ended funds, which I'll talk to in a minute. And about 20% of it is because you have higher leverage than the benchmark. Leverage, especially over the past 10 years, it should have absolutely been accretive. It's not a bad thing to have tracking error if you're getting paid for it. This analysis assumes that all your core assets are truly core, and we don't think that's the case. And it also doesn't factor in that you have unusually high operational risk because you have chosen to step away from the very highly vetted structures at the managers and do tasks in-house that are ordinarily performed within those structures and controls. So putting it all together, you have a lot of uncompensated risk here. You've got extraordinarily high risk and underperformance.
Margaret, can I ask you to please expand to say that our presumed core is not core is fairly explosive. If you could expand on that a little bit, that would be great.
Could you please turn to the next page? You have 69 properties. I think that probably less than half of them are core. Now, it is, so first of all, it is LACERA's policy that once something moves into core, not to move it back out again. A core asset is an asset. It's a high quality, well located, well leased, well maintained asset with durable income stream potential. And it means an asset, for example, that would be purchased by an Odyssey core fund at prices that we quote as core prices. Non-core assets have more risk and they tend to trade at lower prices. They're still liquid, they just tend to trade at lower prices. So I went through your portfolio. I probably spent a half an hour on each asset. I haven't run the models. I haven't visited the assets and the comps and done the really detailed work that is necessary to truly understand each asset and its potential. On the other hand, I have 30 years in the real estate business, and most real estate practitioners do know the difference between core and non-core. There's a little fuzziness on the margins, but let me go through a couple of examples. So if you own an apartment building in a market that's not supply constrained, that has a lot of growth, let's say your apartment building is 10 years old, and it was once new, but in the last 10 years, there's been a lot of new supply on the market. Things are fresher, things are more modern, things have more amenity space. And maybe because of all that construction and where there's no constraints on supply, there maybe is a little bit extra space in the marketplace. In order to lease your asset, you're going to have to start offering rent concessions, and you may have some occupancy compromises, and overall your income stream is pointed down, not up or flat. And that is the definition really of a value-added asset, because what that asset needs is it needs to be refreshed to be like modern so that it can lease in competition with the new product and not suffer that deterioration. And that takes CapEx and risk, not a lot of risk, but a moderate amount of risk. That's why it's value added. Another example, in the opportunistic spectrum, most of what's there is office. And on average, by the way, the NACREIF guidelines are, the definition of core is over 75%, over 70% lease, sorry. Usually the occupancy is higher in the much higher in the NACREIF index, but in the opportunistic sector here, you have office buildings that are well below 70% occupied, and some of them nearly empty, and it's very difficult to lease office. So there isn't a clear path forward. It takes a lot of capital to lease office also, and there's a lot of risk associated with it. And that's why assets have fallen into this opportunistic bucket. You also have some assets that have actual impairments one way or the other that aren't like fixable opportunistic. For example, you have an office building that has 8-foot ceilings. That is not a fixable problem, and it's not acceptable to modern tenants because the technology takes up 3 or 4 vertical feet. So there are some things in here that are a little bit more challenged also, but it's sort of the natural case if you don't ideally maintain them, that core assets become non-core assets. So overall, you should sort of think of this as a rotation, and a part of an actively managed portfolio would say, you know, look at this apartment building. Should I fix it and keep it, or should I just sell it as is? And that's part of the job of an active portfolio manager to make those assessments.
Real quick, hold on, Ms. McKnight. Jim or John, is there, Ms. McKnight started off by saying that it was part of our policy that prohibited this rotation. Has there been an investigation, or have we have a new draft of works that's going to allow for the type of fluidity that she's talking about related to these rotations from core to opportunistic? Is there anything administratively that we need to get up to the board for approval?
Jim, can I take this?
Sure.
A couple of thoughts, and I think Margaret's presentation and the StepStone presentation is terrific, so thank you. Up until, actually it hasn't happened yet, beginning October 1st is when we separate core from value add. So currently core and value add are grouped together and are benchmarked together, such that it's an issue that will begin on October 1st. Secondly is historically, how we reported real estate for our book of record was as a single line item, real estate. Part of the investment that the Board of Investments has made by bringing on an administrative service provider, by improving the having an appraisal management service provider, is that we have granularity into the portfolio, such that now when we look at our performance book, real estate is comprised of 90, 100 line items as opposed to a single line item, which also gives us granularity into the portfolio. Thirdly, I think part of an issue may have been goal congruence with some of our business partners, in that many of our IMA managers are paid as a percentage of net operating income. They don't really have capital at risk with us, such that they're in some ways incented to have us put CapEx into the building so long as there's income coming out, and they're still paid. So I think that many of these items, to a long preamble to a short question, Mr. Jones, is that in the structure review, we are going to revisit this specific topic and look at where we need to position specific assets that historically we just did not have the data that we now have in order to dynamically adjust our various portfolios.
So gotcha. So it wasn't a policy limitation. It was a data line of sight limitation into each of the properties from that perspective.
That's correct. We had real estate single line item as opposed to real estate that was a consolidation of 100+ individual line items that could be different properties can be moved to different places in the portfolio.
Okay, great. Super. All right. Any other questions before Ms. McKnight proceeds forward again? We have it? Okay. Thanks. Ms. McKnight, go ahead.
Okay, next page, please. So I showed you this at our last presentation. This is some work we've done just to show that if you invest across 5 to 8 different Odyssey funds, the tracking error rapidly decreases. And that's the benefit of diversification. And that's what I was talking about. You get away from when you have, 80% of your 4.4 tracking error is because you only own 69 properties. This is a fixable problem now. The Odyssey world is big and rich, and you have a lot of choices, and you can build a highly diversified portfolio. And modern portfolio theory tells us diversity is your friend, right? So next page, please. If we look in the first column, your portfolio has 69 positions and it's 31% leveraged. The Odyssey is 23% leveraged. And then you have well over 4.4% tracking error by the time we factor in the incalculables. We compare that to a hypothetical portfolio of 5 Odyssey funds, our top pick funds. These are consistent outperformers. They're probably in the portfolios of those peers that materially outperform. And we picked 5 that were tilted in favor of where our house views are leaning. You could certainly do more than 5. You could pick more specialty funds and more actively manage this. But we just picked, for this example, 5. Those 5 have over 1,600 properties in them. So well over 20 times as many properties, which means the idiosyncratic risk is kind of diversified away. If you have a building that loses a significant tenant, you will feel it in your portfolio. It will be diversified away in this Odyssey mix. It has leverage of 29%, again, versus the Odyssey of 23. That's deliberate, and they are getting paid for it. And then it has far lower tracking error. Also, of course, the assets are actually core assets, except as Tom mentioned, some of them have a build to core, a very small build to core allocation. So there might be a little bit of development risk there. But that's a vision of what an alternative for you could look like. Next page. Now, getting there requires careful thought if that's something that you want to do. The first thing is it will take patience. To sell under perfect conditions, to sell a property takes 3 to 6 months, a single property. So selling 69 is probably going to take a few years. As you do that, you want to look at the market conditions. There is a flavor of the day in the capital markets, and you might want to plan to take advantage of that. You also have the issue as you sell down. If you sell the most popular things, you may have a shorter term erosion in your performance as you shift, but in the long term would be more slated to outperform, and of course would be radically reducing your risk. But that how dramatic that is something that would have to be managed over time, asset by asset, what to sell when. There's also complexities. Your portfolio has been managed in the manner of core funds for a long-term buy and hold strategy. And that means that the managers have secured long-term fixed rate financing, 10-year debt, and they've done a lot of it over the last couple of years as interest rates went down. And unfortunately, interest rates went down even further. So if you sell those assets, you actually have a yield maintenance contract with the lender. So you have a prepayment penalty for selling those assets. You also have just quickly, that the guidance is that prepayment penalty should be netted against the value of the asset in your carrying value, and it is not universally accepted in the real estate world. It's moving towards it, and Tom Hester is actually on a NACRE committee that deals with these issues, and it's moving more toward a standard, but it's not a standard yet. But your asset values don't have a mark to market of the debt associated with them. Also, other complexities are the fact that these assets that are not core do require the valuation that I talked about. You have to figure out, whether you want to sell them as is or put a little capital in and fix them. That is an asset by asset decision that should be done, as I said, in consideration of the models for the asset, knowing the asset, seeing its competitive set, etc. And then there's a handful of other kind of idiosyncratic asset issues that need to be managed. So this is a big job, and it's time consuming, and it requires real estate portfolio management skills and real estate asset skills. Also at a time when you're missing your top 2 real estate people. So we would like to suggest that you think about hiring a focused advisor to actually manage you through this process that has the skills and the bandwidth to do it. And if you want to do this, as you sell down the assets, reinvestment in the funds, the open-ended core funds, is very straightforward. You can get in within a quarter or 2 as you transition. So unlike the non-core, the investment side of things is quick and easy. So that's some thoughts on transition. Next page. Yeah, go ahead.
Question real quick, just before you proceed too much further. On the previous page, when you had our legacy portfolio versus the possible fund portfolio, I want to make sure that I'm not making connection that's not there. Are you saying, I get the principle of having more properties leads to better diversification, less tracking error, but are you suggesting by kind of an order of magnitude that the number of properties that a fund our size should reasonably have in its portfolio approximates closer to 1,600 versus 69? Or
I'm saying you would materially reduce your tracking error if you had many more properties. So it's a question of how much risk you have.
Okay. So but I'm also trying to say, are you suggesting also that we have something that approximates closer to 1,600 properties in order to achieve those tracking error minimization and risk? Because we have 69 now in your possible fund portfolio, you compared it to 1,600. I was just curious, by order of magnitude, are you suggesting that 3 years from now, if we're doing it smarter, our portfolio is going to have looked closer to 1,600 properties than it did 69?
Yes, and the overriding principle is also those 1,600 properties are in the hands of managers that have consistent outperformance.
Gotcha. Okay. I just want to make sure I was okay. Thank you.
But yes, more is better for sure.
Okay.
It's actually an unusual problem to have too few assets. Most people have too many. So there is this concept of too many, but you're far from it. Okay. Next page, please. So and that kind of concludes our thoughts. We're happy to further discuss this with you, but we think that the next steps are, of course, to perform the structure review, and that will incorporate kind of what market exposures you want to have. As part of that, we should think about the manager structure, how many and what type of managers, and embedded in that is, of course, do you want to own buildings outright, or do you want to have participation in commingled funds? And also to be very clear on what the exposure limits are. There are some odd little concentrations in your portfolio, and having exposure limits is a way to ensure diversification, that you don't get too excited about something that's running and incur a lot more concentration risk. And then there's different breakout kind of on the fund side. On the non-core particularly, you'd want to review the exposure targets that came out of the structure review. We can help with the pacing model for the non-core, and then we can start building a pipeline for either the core or the non-core of where you want to go from here. And then with respect to the IMAs, you really need to re-underwrite the portfolio and do the work that I talked about to really understand what's the best future for each asset, whether you should put more CapEx in it, whether you should sell it fast or sell it slow. And we think that you probably need some help to get that done, given the skill set that you have on board right now. So that kind of concludes our prepared remarks. We would be happy to discuss anything if you have further questions.
Okay, thank you, Ms. McKnight, to you and your team. I do have one question in the queue, and then I see Gina, you'll be number 2. But Keith, go ahead, you got the floor.
Thank you. Yeah, that was excellent, Ms. McKnight. I really appreciate that information. When you were doing your analysis, and I know it wasn't a super deep dive, just your thoughts on the impact of COVID, and would that have any material impact on your review, your cursory review, or was it largely in the same space regardless?
It has, but it wasn't that different from the market wide. And I think it's definitely hurting the office sector, but the office sector has been in a multi-decade decline in demand. This was just one more of a series, and at the margin, maybe why more buildings have lower leasing. There was some income impact in multifamily, but it didn't seem like it was outside versus the industry. You do have a lot of retail exposure, and retail was hit hard. But retail, again, even more than office, is having a major oversupply problem and a demand shift away from it. So it's not a great place to be, even apart from COVID.
Okay, thank you. And then just a follow up for Mr. Grable or Mr. Rice. Anything stick out as a surprise to you, John, or anything that you weren't expecting, or was it a confirmation of some things you thought?
Mr. Chair and Mr. Chair, I would say that it was confirmatory in terms of that we have a highly concentrated portfolio with a lot of embedded risk in it. And we have different types of risk that we compound with operational risk. I would say that the surprise to me was that of the 69 core properties that it's not all core, so to speak. I think that, and I think that in some sense goes to the fact that we have better tools now to look at the portfolio. But I think that was a surprise to me.
Thank you.
Jim, did you have any additional comment there before?
I think I echo what John just said, and particularly in core, where we want our exposure to be, relatively less risky, a source of current income. There's a lot of sources of risk that I think this report highlights that I think we can do better in the way we structure that part of the portfolio.
Gotcha. Okay. Trustee Sanchez.
Thank you. So this, I just want to thank the whole team at StepStone. I think this was a very, very clear presentation. It was quite easy to follow. I think that one of the things that I certainly have focused on for years, and I think, to some degree, Herman has made a similar comment, but was just this idea that when we got regular performance updates, we didn't really get kind of a simple narrative of kind of what is happening in the real estate markets where we are currently invested, and what are we potentially missing in other real estate markets, and sort of nothing that sort of started to approach some kind of let's call it a performance attribution, for lack of a better word. But I very much appreciate the fact that you are highlighting a number of, and I was focused purely on the market. I think for me, what you're bringing to light is also a series of uncompensated operational complexity that we also were taking on board, and which I had an appreciation for, but I don't think I realized just how much we may have been kind of giving up on that. And I guess the question that I have is, what you're describing seems like it's going to be potentially a multi-year project to transition this portfolio. And I know John Grable has been leading the effort on transitioning this portfolio already, but can you sort of describe what you envision as a reasonable timeline for sort of achieving portfolio transition, especially in assets like these, which, you know, hopefully we don't have to go through a sale process like the most recent one, but where sale processes take some time as well.
I would think in terms of 3 to 5 years. And as you get into that, you can figure out if there's ways to move parts of it quicker. I mean, you can rip the Band-Aid off, but in many cases, it's being patient will have its rewards.
Got it. Okay. So I guess, does that mean, and this is maybe more a question for Jim and John, is this is the next kind of natural step for this to begin to lay out that process for sort of how this transition could work and begin the process of recommendations for low-hanging fruit versus areas where we need to be patient? Or what is the next step?
I do think we have our structure review scheduled for the end of the year, and I do think a big part of that will be how we do this transition, particularly on the core side, from, you know, largely separate account portfolio to a portfolio that relies on funds. How we intend to manage the sale process of, you know, a lot of assets, and then you know, how we intend to moderate our exposures over time, so that we're not, you know, selling the best assets and not being well positioned in the interim. So I think that's going to be a big part of what we do. We also have to fill out the non-core space, and as we reallocate potentially some of these assets to non-core, that could, you know, solve some of that problem. But I think there's a longer term question about, you know, underwriting non-core funds, and so that'll be another big part of our process. I think we're kind of viewing that, I think, as a second step, how we get there, but kind of the transition of the core is the primary immediate emphasis in the structure review.
Thank you. And I don't think I have to, you know, tell the StepStone team this, but I will kind of highlight from my experience that when you go through a transition like this, inevitably the very good properties sell quickly and the very bad properties stick around, and it creates this negative performance effect during the transition.
Yep.
So just kind of, before we go into this process, let's just remind ourselves that that's what we may be faced with, and we'll have to manage that as well.
That's the challenge.
Okay, then are there any other questions? Oh, let's see it in the chat window here. Oh, John, looks like you had a comment.
I'm happy to wait till after Mr. Bernstein. I was going to add on to Jim's answer.
Why don't you go ahead and add on to Jim's answer, then we'll have Vice Chair Bernstein ask this question.
Okay, thank you, Mr. Chair. I would say two things to add. One is, you know, we as a team agree with Ms. Sanchez in terms of adverse selection. Absolutely, we're mindful of adverse selection in terms of what's easier to sell may not be what we want to sell.
Hmm.
The other aspect to build on to Jim's answer is the team, in that we want to transition the majority of our workload from administrative functions to strategic type of functions to kind of, as we look at the portfolio every day, is that attribution analysis that Ms. Sanchez is referencing, that we want to add value to increase returns, mitigate risks from how we structure things each day, as opposed to just doing ministerial tasks.
All right, Vice Chairman Bernstein.
More of a comment than a question. I really appreciated the report from StepStone. It's not exactly the kind of report that lends itself to saying one likes it, because it's sort of a series of painful facts, but I really appreciated how it was put together. And although I've only been on the committee for 3 years, because I'm a real estate person in my outside life, my conversations with real assets started years ago under previous leadership, under previous CIO. I just am struck that basically we're talking about strategic asset allocation, Mr. Grable's favorite topic, and the challenge of at least in my perception, coming from a portfolio that tried to control risk in other ways besides strategic asset allocation, and particularly that relied on core. And I think there's a reason why StepStone has discovered that we've overdefined core, because I think we've been enthralled with it. And in doing my own real estate development, I've been really struck at how in markets, 5-year-old apartment buildings in certain markets aren't even being really described as core anymore. That core is really an evolving term, and StepStone touched on that really well. I just think this is a good direction. That's my comment. But in order for it to succeed, I think we all, StepStone staff, the board, need to get on board with how we look at risk, how we embrace risk in real assets, how we look at the variety of options, and how also, especially after our recent experience, how we grapple with the reputational risk attendant to certain forms of real assets, although they may have great upside value from an investment point of view. So I think it's a really broad, expansive conversation. I absolutely agree with Mrs. Sanchez that better things sell fast, which creates odd ripples and perception challenges that we should be prepared for. I think this is a good direction, but I do think that COVID pointed out something that was actually fairly clear all along, that there are no real assets that have no risk, that we were trying to live in a fantasy world where we could actually minimize risk. And to quote the estimable Mr. Grable, the way we minimize risk is through effective strategic asset allocation. And frankly, that's enough. So I'm excited by this direction and looking forward to seeing where it goes.
All right. Any other responses from the committee or any of our other trustees before we let them move on to the next agenda item? Anything else? Again, thank you, Tom, Anja, Margaret, to you and your team. We look forward to the continued work of you along with our real estate team. Thank you.
Chair Vic, thank you. Have a good day.
All right. Linda, any other items for staff review? I didn't see any in the packet, but any other items for staff review?
Chair Jones, it's Carol. I'm reconnected. No, there are no items.
Okay, gotcha. Good morning to you, Carol. Sorry we missed you earlier.
Sorry about that earlier.
No worries. And then finally, good of the order. Any comments for good of the order before we adjourn?
You want me to do a roll call or?
Yeah, why don't we go ahead and do the.
Okay, Mr. Knox?
We'll start the BOI at 9:05 a.m.
Okay, Mr. Bernstein?
Good to be with everyone.
Ms. Sanchez?
Happy Rosh Hashanah.
Mr. Green?
Buenos dias.
Mr. Santos? Oh, cute.
Yeah.
Happy
I
Rosh
love
Hashanah.
it. Oh, how cute. Mr. Keto?
Morning, good morning.
Morning. Mr. Kelly?
Thank you to StepStone.
Thank you.
Okay, and then as a chair, then it's with the opportunity for the last word. I have none. So look forward to good meeting with Keith here at 9:05. Thanks, everyone. Thank you, Carol. And, Linda.
Thank you. Sorry about that. Thank you.
Okay.
Bye-bye.